let's also welcome on board Pankaj Murarka and find out what he's making of the upcoming earnings season and what is it that we can expect. Pankaj, hi, good morning. Wish you a very happy new year from all of us here. Pankaj is wondering whether earnings can finally add some cheer to all this recessionary talk all around.
Morning, Aisha. Wish you and all your viewers a very happy new year. I think, since we started the discussion with recession, and that's the most talked about event in the financial markets globally. One point I really want to highlight is the recession which probably US and some of the other Western world is going to face during the course of this year is not necessarily bad, because this recession is going to be very different than the recession that we have seen in the Western world over the last 15 years post the global financial crisis. A recession in a disinflationary environment, which is what we've seen over the last 15 years, are very different than the one which we are going to see this time around, where it will be a recession in an inflationary environment. And my take on this is probably this will be a recession where, despite a recession, US will still have earnings growth at aggregate level. Please remember, bear in mind that this economy, when we talk about US economy, and because that drives a lot of flows and gives cues to global markets, at the onslaught of pandemic, that was an economy which was about $20 trillion. Because of the high inflation of 8-9% that they have had for the last 2.5-3 years, it's an economy which is now $25 trillion. We have not, which is a significant addition to their overall GDP numbers, and that there is that much more money floating around. And when we evaluate markets from some of these very high level metrics like market cap to GDP and all of that, US markets are not so expensive. So in that context, I feel that one, the recession in developed markets is not per se so bad for developed markets themselves. And in that context, I think given that India still continues to grow and our growth is resilient despite these headwinds, we need not fear that. And I think we are in for a reasonably good earnings season going forward over the next month or so.
Okay. Pankaj, let's look at the chink in the armor. And the chink in the armor here is what is happening to the headline US tech stocks. Now, we may endlessly argue and say, okay, those are product companies and we are services. The return ratios are different. The business is different. They are customer centric. We are company specific. They are B2C. We are B2B. I've given 4 instances why different. You can add another 4. But historically, when tech globally does poorly, IT stocks do not do well. It's a very simple correlation which has been observed in the last 15 years. Do you think that factor could be the impediment? Now, mathematically, I cannot establish it, but sentimentally, it has turned out to be true.
So I agree with you, Nikunj, that it has a sentimental rub-off effect. So to that extent, while tech has fallen in US and Nasdaq has corrected, Indian tech stocks have underperformed this year, and partially because of growth concerns as well with their clients. But my take is slightly different. I think if you look at Nasdaq also, meaning there is a significant dispersion in the performance of the index. So some of these very profitable companies, let's say likes of, and the leaders out there, let's say Microsoft or Apple, while they are down some 20-25% odd, there is a large pool of companies which are loss-making or not profit-making companies which are down 60-70%. Having said that, obviously the index has corrected by about 35% or so over the last 1 year. My sense is that when I look at this, some of these large cap companies like Microsoft, Apple, Google, they're still growing high single digit, 8-10% despite a recessionary fear in dollar terms. That's very significant. So my take on this is that while I'm not an expert on US markets, but the sense I get by looking at some of these companies and reading some reports and talking to a few folks out there, probably the Nasdaq index itself is around a trough because at about 25-26 times 1 year forward earnings, and given the fact that the index level earnings are still growing at 10-12% in dollar terms, the index is not as expensive at this point of time as it was at the same time last year. So probably few stocks here and there can still correct, but the index level, my view is that the lows for this recessionary cycle in US for the US markets are already in place. I don't think US markets, be it the S&P 500 or Nasdaq, when we're talking about global markets, are not going to. I don't think so. They're going to make a new low. They might retest those lows, but I think the lows for this cycle are already in place. So I remain positively biased even in global equity markets.
Good morning. What's your outlook when it comes to some of the manufacturing companies? Do you think that the fact that we've seen a softening in raw material prices could aid margins for these companies down the line?
Absolutely. So obviously, one thing which is clear and evident is over the last 12 months or 15 months, we've seen companies across the board taking very sharp price increases because all of a sudden, these companies have experienced the kind of inflation which they have not experienced in their life, where raw material costs have gone up by 20, 30, 50%, and they had no choice but to pass that to their customers, albeit gradually, but they have done so. And as a result, as a consequence, we have seen some rub-off effect in demand in most of these companies, and it's more evident in the consumer sectors where post Diwali, while sales did pick up during the festival season, and there was a momentum up till Diwali, but companies across the board, consumer durables, consumer companies, and discretionary companies have been highlighting that things have slowed down materially post the Diwali festivity and all of that. I think probably from this quarter onward, we'll start seeing some improvement in margins. It might take few quarters before companies realize the full benefit of correction in raw material prices in their margins. And I'm sure many of these companies will again want to pass on some of these margin benefits to their customers to drive their sales. So yes, I would expect some margin benefits coming across manufacturing companies, be it consumer companies, or let's say some of the commodity companies, including metals and cement companies, which have seen very sharp price hikes in the raw material cost impacting their margins. We'll see margin benefits starting this quarter.
Pankaj, how much of the good news, good recovery, good margin expansion thesis is in the price for manufacturing companies? Because whether it's ABB or Siemens, whether it is a ACE or Elecon Engineering, all these stocks are trading at levels which historically are which are above the historical averages. Let me put it simply.
There is no denying the fact that Indian markets are reasonably expensive and absolutely expensive in the global context. My only point here is they'll continue to remain expensive, because if you are one of the fastest growing economy in the world and you have a solid secular growth story, then everyone across the world wants to own that. And you cannot buy the highest growing market. And I would think India is a high quality market because of the aggregate level. At the index level, we do 15% ROE, and there are companies which do ROE much, much higher than that, and which have secular growth story over the next 5-10 years. So you cannot buy the highest quality market, the fastest growing market in the world, cheap in the world of equities. I think we have to reconcile to that. Coming specifically to Nikunj, to some of these companies talking about ABB, let's say ABB or Siemens, bear in mind now this year or last 4 quarters, ABB or Siemens are the companies which have delivered the highest earnings growth amongst the top 500 companies in India. This year, ABB is going to do earnings growth of something like 50% when your index earnings are growing at 15%. And that's because, one, there's a significant momentum in their business. Just 2 weeks back, Siemens won an order of about 28,000 crores from Indian Railways over the next 10 years. Now, remember, this is a company which does about 10,000 crores of revenue. A single order is like at least 30% of their revenue, and that too with the visibility over next 10 years. And we are saying that all of these companies, including let's say Indian Railways, are going to accelerate their capital expenditure. There is a significant amount of investments and activity happening with new projects, be it with clean energy across green or blue hydrogen, or across railways, or across government expenditure, and private investments is accelerating, which effectively means these companies, to my mind, probably will be amongst the corporate India some of the fastest growing company over the next probably next 5-7 years, and also that means that these companies will witness significant margin expansion, and their profit growth will be significantly ahead of their revenue growth. If that be the case, then we've seen in the past something similar happened in consumer sectors, let's say in 2014 to 2017, where a lot of these companies, the so-called darlings of the market, Asian Paints or DMart, they were trading at multiples which are 70, 80, 90 P. So when stocks go through this very strong growth cycle in their revenue and profits, they tend to be market tends to price that growth much earlier or much ahead of time, and which is where optically from a next 12 months perspective, these stocks look very expensive. But what market is trying to do in that sense is trying to price their medium term growth. So in that context, yes, you're right that these stocks are expensive, but my only point here is they'll continue to remain so. You don't have a choice with that.
Okay, Pankaj, great to have you on the show and get in all your views on the markets and, of course, more importantly, earnings.